Hi everyone, welcome back to the USCPA classes for financial accounting and reporting. In this particular video, which is part 2 of payable and accrued liability, I'll be covering in detail about cost and expense. So let's dive into to finish off the topic payable and accrued liability.
Hi everyone, welcome back to FAR class. So today we'll be finishing off first this payable and accrued liability, in which we have already covered current liability, liability arising from exit or disposal activity, as well as we have covered non-governmental not-for-profit expenses. So only like cost and expense part was left over from the last class. So that will be finishing, and then we'll jump onto the new topic, which is very next topic to this in your book, which is long-term debt. Right. So we have covered, we are in like 3.7 payable and accrued liability. So current liability is done, liability arising from exit and disposal activity is done, and non-governmental not-for-profit expense is also done. So we'll be covering this cost of expense. Then we'll be investing our time in understanding more in detail about long-term debt, which include not payables, bonds payable, modification, extinguishment of debt or payables, and then trouble debt restructuring and debt covenant compliance requirement. So let's jump into the first one, cost and expenses, which is left over from the 3.7 topic. Yeah, there you go. So cost and expenses. So it may result either into like expense to income statement or maybe the losses to the income statement, gain or losses. So expenses may be like consumption of benefit. Expenses generally include like consumption of the benefits. Expenses are generally recognized when enterprise economic benefit are consumed in revenue, like matching concept. I'm sure you all being very well aware of, like same as in when you recognize the revenue for any particular services or product which you have provided, at the same time you need to recognize the cost of goods sold or cost of the services provided, right? So that's as per like matching concept. And then expenses are outflow of assets or incurrence of liability. So expenses may result into either outflow of your asset, that means your cash generally go out or your bank account generally go out. If you see like accounting entry for expenses is expense account debit to payable respective party, so either it may increase your liability, or expenses account debit to cash, or it may reduce your asset. So that's what like the expenses are all about, and expenses are accrued based on the matching principle which we have discussed. So this is very basic, very general, which you are studying from 11th standard, so nothing new in it. So losses are recognized if it becomes evident that previously recognized future economic benefit of the assets have reduced or eliminated, or that liability have been increased without associated economic benefit. 3 4 things here in this one small statement. First, if you see what is losses. Losses, it may be result into reduction in the value of the asset which you have, right? We generally recognize as an impairment loss, right? Or losses can be on account of any litigation, claims, or assessment which you need to pay later on, right? Or which you need to pay upon, like negative, you can say the judgment came against you, right? A third could be like when you are selling any particular assets and you are selling that at the less prices than the book value, so that may also result into the losses. So if you relook at this definition of the losses, losses are recognized if it become evident that previously recognized future economic benefit of the asset. What is previously recognized future economic benefit of asset is book value of the asset, right? Have reduced. That means book value of the assets has reduced or eliminated, right? So that means the value which you are having for the assets has gone down. So it may be either on account of impairment, or it may be on account of when you are selling it out, right? So you need to recognize the losses for that, or that liability have been increased without associated economic benefit. That means no additional economic benefit has increased, whereas the liability has increased. So that also being considered as a loss. For example, impairment loss, loss due to fire, etc. And losses are decrease in the net assets. So we all know like what is generally expenses and what all things to be considered a loss. Just a reiteration of the same which you already know. Next concept is imputed interest on receivable or payable. Have you heard this term before? Imputed interest? Hmm?
No,
Ayush, Akash?
no, sir.
So imputed interest is basically the interest to be calculated on receivable or payable based on the effective interest rate. So which is not specifically mentioned in the instrument, but we'll be calculating to identifying the finance cost or finance income. Imputed interest is estimated interest rate on debt rather than the rate contained within the debt agreement. So imputed interest is used when rate associated with the debt vary from the market rate. So market rate is generally considered as the rate of interest to calculate the imputed interest. The difference between the face value of debt or note and the present value of the imputed interest is recognized as interest income or expense. For example, like if you have issued a debenture, 10% debenture of 100,000 each. So whereas the market rate of interest for the same, this is 5-year debenture, and you have issued 5-year debenture at 10% interest rate. Whereas you can take the same amount on the loan for the 5-year as an unsecured loan at 7% of interest rate. So in this case of scenario, you are paying interest more, whereas your actual market interest rate is less.
So that 3% is imputed rate of interest.
No, imputed rate of interest is 7%. So we'll be calculating the fair value based on the imputed interest rate minusing the value at which you have issued. The difference would result into interest income or interest expense as the case may be, and would be amortized over the period.
Okay, got it.
Right? So let's do a practical question here. During the current year, Casual Wear Company had total retail sales of 800,000 and collected a 5% sales tax, state sales tax on the sales. At the end of the period, at the end of the prior year, Casual Wears had $4,500 in sales taxes and had not been remitted to the state authority. During the current year, Casual Wear remitted $39,500 in the state sales taxes. What amount should be recorded in the Casual Wear current year financial statement? So just look at the question again. Here you need to make a T account for the state sales tax probably to reach to the number. First is during the year, company had total retail sale of 800,000 and collected 5% state sales tax. So what is the 5% of 800,000? What is the 5% of 800,000?
40,000.
Second, let me open my Excel sheet for you.
सर वो तो total retail sales है 800,000. So 5% would be included in that. Now we'll divide by 105 into 5%.
Okay, one second. Let's see. During the current year, the company had total retail sale and collected 5% state sales tax on all sales. So maybe let's say it on this. State sale tax collected during the month is this. At the end of the prior year, casual wear had 4,500 on the taxes that has not been remitted to the state. That means opening balance. How much is it?
4,500.
4500. And
Correct.
current year sale tax is
40,000.
40,000. Right. During the current year, casual remitted 39,500. Sales tax paid how much?
Minus 39,000. 39,500. Okay.
39,500. What amount should record in the casual current year financial statement? How much it will be?
5,000.
5,000?
Right.
Yes, Ayush.
Yes, sir. Yes, sir.
Right. So third answer is correct.
Correct. Correct.
Okay. So this was the last